Hello, Jim Seacott here with Polaris Mortgage Planners and Axiom Mortgage Solutions. I wrote out a few suggestions to set you up for success in qualifying for a mortgage. So I'm just going to read from it so that I don't miss anything. Lenders look at four things: income, credit, down payment, and the property. So income, full or part-time permanent income, not on short-term contract, with salary or guaranteed hours and off probation is what they like to use. Non-guaranteed and self-employed income, they want to see 2 years of history in that same position. So they will like to look at tax returns so they can see what you claimed and that you have paid your income taxes, and to also ensure that you have been doing the same line of work. They will use a 2-year average at that point as long as the income is increasing each year. Otherwise, they will typically use the income from the most recent year, which is lower, for running the qualifying numbers. Credit. Lenders like to see 2 active trade lines for at least 2 years. If you only have 1 credit card in your name, I suggest getting a second credit card. Good if each of the cards have a minimum of $2,000 limit. Use it occasionally, pay it off before the statement due date to avoid paying interest. Just be sure to keep the balance below 50% at any time within the 2 months before qualifying so that it does not hurt your credit score. This is because all cards report at different times within a 30-day period on your bureau. So when we pull your credit, it may show a balance you had from, let's say, 20 days ago and not today, for example. If you only have 1 credit card, once it is past a year old, we can use other things such as utilities in your name, rent, car insurance paid monthly to help prove up your credit. But the easiest is to have 2 credit cards. Then you will always have 2 traditional reporting trade lines, or two trading trade lines reporting. If you want to pick up a 3rd credit card for some reason, do not close one of the other ones until you've had the 3rd one for 2 years. This way you always have them overlapping. Down payment. Lenders look back 90 days in your down payment bank accounts to verify your down payment. They will want to see if any of the money is new money within the last 3 months. If any of the down payment came into the account within those 3 months, where did it come from? If it came from your regular income paycheck, no problem. If it came from a transfer from another account, they want to see a 90-day history of that account as well. Whatever account that the money has touched in the past 90 days will be brought into the equation, which can create a lot of paperwork to trace the movement of money. If it came as a gift, it must be from an immediate family member: mother, father, brother, sister, son, daughter, grandparent, or an aunt or uncle on exception. If you sold something and that money is making up part of the down payment, they may require proof via a bill of sale if it is over $1,000. If it came from cash you had sitting around at home, they will not consider that. You would have to wait for the cash to be in your account for at least 90 days to use it as proof of down payment. This is a way for them to mitigate fraud and money laundering. Typically, once you have proven that you have the down payment, it doesn't matter if you use other money for that actual down payment, because you've proven that you have the money to cover it. If you are using RSPs or gift money, they usually want to see that amount put into your account. Also, RSP money must seed, which means be in your RSP account for at least 90 days before you can pull it out for the first-time home buyers plan. If possible, when you know you are about 4 months out from getting qualified for a mortgage, be sure not to move money around too much. Put it into one account at least 90 days out and let it sit there. It is the easiest for paperwork. Also, keep your transactions in the account during those 90 days to a minimum if possible. Property. This is a lender's security. If you stop paying them and they get stuck with your property, they want to be able to easily sell it for more money than you owe them. They only get to take from the sale what they are owed and the costs incurred to get their money back. Any extra goes to the next person in line. So if they're the only one owed money registered on title of your property, then the rest would go to you. The courts also make sure they sell it at a fair value, but the lenders do not like going through the process. They just want to make sure that if they do, the property is not hard to sell. You also do not want to go through the process because you could have sold the property yourself for more money, You would not have to have covered their legal costs that they incurred to put you through the process. And now your credit is bruised, and future borrowing will be more difficult and costly for you. So when you're looking at properties, remember the more unique they are, the more of a fixer-upper they are, the further up from town they are, and the larger they are from normal or smaller from normal, the narrower the lender choices become. To sum up, income. Guaranteed income or 2 years income with tax history in the same career position is good. Credit. To credit trade lines with 2 years active history with at least $2,000 limit and balance below 50% is good. Down payment. In one bank account for over 90 days, preferably without much other activity in it, good. Property. Normal and in good shape, and the offer to purchase that you have is at a fair value, good. All right, makes sense? If it's outside of these parameters, as a broker, we do have access to a lot of different lenders out there, so we work to try and make it fit somehow, somewhere. But these, if you follow these guidelines, this is the easiest way to qualify and have the most choices for lenders and terms and rate, right? All right, if you have any questions, let me know. Jim Seacott, Polaris Mortgage Planners at Axiom Mortgage Solutions. Have a great day.